Oh my God, your glasses are awesome. Oh, I can't hear you. You're muted. There you
Oh,
go.
sorry. Thank you very much.
Look at you. You're in uniform too. I love it.
Yes, this is for the alumni.
I love it. I love it. I'm obviously not practicing because I didn't, I didn't hear anything.
It's quite all right.
So, well, awesome. Should I try?
So how long does the session last? An hour and a half?
So the entire session is about 2 hours. So on the agenda, do I have it pulled up here? Oh, I need to pull that up. On the agenda, I actually am going, what I'm going to do is, let me just pull it up here because I want to be respectful of your time. And
Mhm.
so I'm going to do we'll do, Adrian and I will do the introductions, and then we'll just cover the mission of the club. And then we're going to introduce you. So that way you can go ahead and kick us off, and then I'll come back and do all the other club business stuff on the back end. That way I don't tie up your time unnecessarily, but because we usually go for about 2 hours.
Okay. All
Okay.
right. Understood.
Good. And so you have, what is it, a sophomore or a junior at Morehouse?
I have a junior at Morehouse.
I have a junior at Morehouse too.
Okay, good.
Yeah. Is he on
And,
campus? Is yours on campus?
yes, he's on campus.
Okay, ours is not.
Okay.
He
I
forced,
wanted it that way.
oh, I wanted it that way. He forced our hand by not applying for housing. And so
Oh,
it was like, oh, well, mom, I guess I need an apartment, you know? So
right.
I'm like,
How
you gonna be
clever.
homeless. You about to be homeless.
I know, don't take gambles like that.
Exactly, exactly. All right, let me. What's he majoring in?
Kinesiology.
Oh, nice. Very nice.
Sports medicine. I was watching a show yesterday that showcased the new gymnastics team, the first HBCU gymnastics team at Fisk University.
Really? Yeah.
And it was Jennifer Hudson who had them on the show. And they went through explaining their majors, and one of them said kinesiology, and Jennifer
Yeah.
said, please tell everybody what that is, because I don't know. And that tickled me because it's just, a lot of people just haven't heard of it yet.
That's right. That's
Yeah.
right. No, that's true. Oh, that is so awesome. That really
Thank you.
is.
And my baby, I just got back from DC. She's a freshman at Howard.
Which is so awesome.
It
I
is.
saw your post on LinkedIn. You're like, I really tried to my
Yes, I
sisters.
did. Yes, I did. Yes, I did. I tried everything I could. I even offered a car, Jennifer.
Oh my God.
But she really loved DC. So
Listen, I hate to admit this, anybody else on the call? Actually, Howard was my first choice, and I ended up having to turn down Howard because I had a daughter in high school, and so I did not have the family support
sure.
in DC that I did in Atlanta. And so
Sure.
yeah. But really it wasn't necessarily Howard, it was DC that I loved.
Sure. That's how she feels, because right now, unlike Spelman, some of those kids at Howard start their major classes right away, and she chose architecture.
Oh wow.
And it's pretty intense from the
Yes.
start.
Yeah.
So,
I
yeah.
could see that. I could see that.
Yeah.
And that's probably not something she would have been able to get at
No.
Spelman anyway. So
No, I mean, Spelman tried to tell me they have it, but based on the work she's telling me about, the assignments they have and the detail that the professors require and the
yeah.
specs for their laptops with advanced graphics, I don't think we would have done it that way at
No.
Spelman for her first year.
They were selling you.
Yeah, I think they were. They were like, we can got math.
Right.
We
Right.
got, we can make it happen.
No. Okay. Trying to log in. It's not letting me. Let me see. Okay, what am I missing? Let me see. Did I change the password? Oh, you know what I can do? I know what I can do. So do you work virtually? Are you in the office? Y'all back in the office?
It's a hybrid approach. So not every day we're in, like, so tomorrow I'll probably be in for a while.
Oh, really?
Mhm.
Is that the same for your team as well?
Yes, it is,
Okay.
but I found that the younger analysts, they enjoy like 3 to 4 days in the office
Really?
versus those
Interesting.
of us who've been, with the company more than 15 years.
Yeah,
We don't necessarily have to be there to do our work.
sure,
So,
sure, sure. My son did a internship this summer for FEMA. He had an accounting internship that fell through at the last minute.
mhm.
And then he ended up interning for FEMA, and they, for some reason, which I thought was really interesting, allowed him to work virtually, which I was like,
Yeah.
you need to be in an office somewhere. I don't trust you, that was me, but I think he did a good job because they've offered him another internship. So,
Good.
but I'm
That's
like,
awesome.
really?
That's pretty awesome.
Yeah. So where did you grow up?
So I'm originally from the Gulf Coast, from a city called Mobile, Alabama.
Mobile. Okay.
Mhm.
Okay. And you came to Atlanta for school?
I did and never left. So after Spelman, I went on to get my MBA from the Gosueta Business
Yeah.
School. And that was back when Dr. Janetta Cole put together the Spelman Emory Partnership Program.
Okay.
And it was for 3 students to receive full fellowship. So I did that really early, started investing for high net worth individuals and did
Yeah.
that about 5.5 years. And then I joined Southern Company in 2000.
Okay.
Mhm.
So right around the time your son was born,
He
almost.
was born in 02, yep.
Okay.
And
Okay.
my daughter was born in 04. So I got an understanding of the role for about a year and a half. And then it was head down, being a mother, a wife,
Yeah.
and, in a corporate role that was demanding. So
Yeah.
I often talk to women about, networking and making relationships. During those years was just I didn't make room for it. It was enough to do to work and be a
Absolutely.
mom and all that. So
Yeah. Yeah. Yep. I had I was just crazy. I did everything backwards. Because I'm trying to pull everything up here. So my apologies that I'm like all over the place, but
fine.
I had a daughter coming into Spelman, and then I had my son during my senior year.
Uh-huh.
The craziest thing ever, but I didn't want to have to start over because I got married in my sophomore year.
Mm-hmm.
And then I didn't want to have to stop so that I could have kids and I
Right.
didn't have to deal with that. So
Right. Jackie.
she's connecting.
I haven't seen Jackie in a month of Sundays. Good
Really?
Lord. So she and I met at our business school in the MBA program.
Oh, nice. Jackie actually lives close to me.
Uh-huh.
Which I just found out. Hey, Jackie. Hey, Robin.
Hey, Jackie, good to see you.
Okay, I don't know what is going on here. Why I cannot pull any of this up.
Hello. Hey. Hello.
Hey,
Hello.
Jackie.
I haven't seen you in so long, Takia.
I know. I was just telling Jennifer, it's been a minute.
Right? Congratulations. I'm excited to hear you talk tonight. Looking forward to
Thank
it.
you. Thank you.
She's
Let's-
really the reason why you registered tonight, isn't she?
No, actually, no, I didn't even know that was perfect. I looked up, I was like, oh my gosh, that is perfect.
Oh my goodness. I'm using a new computer and none of my passwords are saved. Let's see. Okay, I'm gonna mute out so I can figure this out.
Happy wonderful Wednesday. How are you today?
Good. How are you?
I'm amazing. Thank you for asking.
Good.
Hello, hello.
Just my volume.
Hello, sisters.
Hello, everyone.
Hey, Adrian.
Hello.
Hi.
Hey there, everyone.
Hello. Hello.
Y'all, I've been trying to get some music going, but I'm just having all kind of technical difficulties.
We're not getting any music today. That's not.
I've been trying to get it together. See, Suzette helped me, and I am just falling flat on my face over here.
All right. Will anybody sing?
Nah, we don't want that.
Songstresses over here.
Please don't break my soul with that.
Oh, that's funny. That is funny. But I am excited because I saw just a ton of new names, Adrian. I'm super.
I'm
duper
looking
excited.
at the list too.
Yes.
All right.
So this is going to be
What's
awesome.
going?
This is going to be awesome.
Well, let me see what time is it?
It's 6:30, so we can.
Okay,
go
we
ahead and kick it
definitely
off.
we
Yeah.
have to get it going.
Hey, can I get co-hosting ability? For some reason, I don't have it.
Absolutely. Is that something? Okay, I said absolutely and not knowing how to do it. Hold on. Let's check.
Oh, let me get out of here. So you only see one profile.
There you go. I think I've done it.
You got it? All right.
So Jennifer, should I kick us off? Are we ready?
You can kick us, Dakia. Can we get you to stop sharing just for a few minutes?
Sure. of
Okay.
course.
So good evening, ladies, and welcome to our Wealth Building Wednesdays, hosted by the National Alumni Association of Spelman College for the Atlanta chapter. I'm Adrienne Lance Lucas, serving as the president for this beautiful chapter. And we are so excited to have you because women's financial empowerment is so very important. And we began this series, for those that are new with us, we began this series during the pandemic. And part of it was as a result of what people were really encountering, what they were experiencing during the pandemic. Some lost their jobs, others were reassessing, right, their professional activity and really trying to make their dollars stretch. But in addition to that, I think it was just the time for us to really think about where we were in our lives. And we partnered with Bank of America that first year, and they sponsored a phenomenal investment series for us, taking us from the history of Black wealth and then beginning to look at various asset classes. From that, it evolved into this edition, which is our investment club edition. So we wanted to take the things that we learned and put them into practice, hands-on. And Jennifer and I are strong believers that you can have people tell you what to do, but unless you do it hands-on, it does not have the same impact. For all of the people, the greatest advisors that you will have, it still doesn't make all the sense that it needs to unless you can do it yourself. And so that is why this particular club exists. Tonight, we are going to hear from a phenomenal speaker. And, we love to brag on our Spelman sisters, of course. So if you all have not read Dakia's bio, you are in for a treat, just based on if we can just get a little bit of what she has experienced. I just want to point out a couple of key things about Dakia. Number one is that she has a designation. She is a CFA, and I'll probably get it wrong, Chartered Financial Analyst. Am I right?
That is correct.
So in the time that Dakia actually received this designation, very few Black people, period, not even to mention Black women, held this designation. But I'm happy that she is one, and I know of one other Spelman woman who holds that designation. The second thing that I want to share is that Dakia is the Chief Investment Officer for Southern Companies. So when you think about Fortune 500, Fortune 100 companies, taking our little bit that we have in our wallets to invest and make those decisions, she's doing it on the largest scale that you can imagine for a major corporation. And so we are extremely proud to have her with us this evening. So Jennifer, I'm going to stop there, and I want to introduce my partner in progress, Jennifer McReynolds, who is also a financial planner, investor, and working with Primerica. She and her husband, who is also a Morehouse grad, has been on this journey with me to help this vision come to fruition. So Jennifer, I'm going to turn it over to you, and we'll proceed with the rest of the evening.
So I'm super duper excited, man. That's such a big deal to have someone who is both a CFA and also a CIO, which is making the money decisions for a company. That's a big doggone deal. So we're super duper excited about that. I am as Adrienne said, I'm the co-chair for the Spelman the National Alumni Association's investment club for the Atlanta chapter. What I absolutely love about what Adrian and I are doing is that we've opened it up so that any sister from any chapter across anywhere can actually become, join the investment club. And so absolutely, Adrian, this is a passion for me. I'll talk about my bio a little bit later, but just why I do this and why Adrian tapped, for me, it's a personal thing. My mother, as I was getting ready to start college, I had a child. That's a conversation for a whole nother day. But I had a baby before I started college, and I knew that I needed my mother. I grew up in Florida. My mother, I moved to Atlanta, and I said, Mom, I really need you. My mom had been pretty much a homemaker. She took care of us kids. I have 2 siblings. And so she was great at what she did. And so my dad said, okay, I'm going to move your mom up there, for a while so she can help you out. And I thought this was going to be awesome. And so as my dad finished moving my mom's stuff in, he says, oh, by the way, your mother can stay there with you forever. I'm moving in with my girlfriend that I have been with for the last year. And so at that time, what happened were 2 things. I became very, very money motivated because not only did I have this child to take care of, but now I had my mother to take care of, because she was in a position where she had not worked up until that point. She had taken care of us kids and did not have anything, did not have a retirement. And so she found herself in a very interesting position to not have anything. And so I didn't consciously at that point make the decision, but I said, one thing I did say is I'm not going to be her. I'm never going to put all my eggs in that one basket, because I want to make sure that my kids will always be okay, that I'm always, whether I'm in a partnership or not, is be able to take care of myself and mine, right? And that I need to be able at some point to give back and bring some other women along with me, because I know there's some other women that are in the same position, right? And so that's why I do what I do. And so Leonard and I have created a company within a company to really help in that financial planning and investment advisory process. And then I get to choose who I work with. And I absolutely will, most of the time, a majority of the time, is choose to work with women, because that is my absolute passion. And so what we hope that you get from this is a couple things. We don't expect for you to be an expert. That's not what the investment club is about, but it is about making sure that we grow our learning, right? Because I think what I saw with my mother is that she didn't know where the life insurance policies were. She didn't know where the savings. So look, we need to know where does the money reside, right? Number one. Number 2 is, can we learn a little bit about how that money works? Because that's very, very important. So making sure we can further our knowledge, learn about all asset classes. Man, our goal is to expose you to all asset classes and how to learn to really analyze how to make an investment in all those asset classes, right? And we're doing that by exposing you to guest speakers, to subject matter experts, right? And doing that in a collaborative environment, because we do believe that together we can get a lot further by doing this, okay? And so we're going to come back a little bit later on to talk a little bit about the club specifically, but I want to really just turn it over. Adrian, I do have Dakia's bio here, so I'm happy if you want to make a more formal introduction in her background. I'm happy to pull it up and share it so that we can just go ahead and kick it off with Dakia and what she's here to talk to us about. Yes, where the money resides, y'all. Okay. All right, let me pull it up here. And I think you should be able to see it. If I need to blow it up, I'm happy to blow it up a little bit more.
Okay, I'm not going to read all that.
Okay.
I'm not. I pointed out the pieces that I thought were significant, but let's see.
I can help you out, Adrian.
Why don't you do that?
Okay.
Let's start with the Spelman piece, Dakia,
Yes.
and then how you got to where you are. How about that?
Absolutely. So thank you so much for having me, Spelman Sisters. It is quite a privilege and an honor to join you in this incredible effort to have an investment club among you. A very special shout out to my classmate sisters, class of 1993. I see that several of you have joined.
I see Sabrina.
And I see Crystal Sidbury and some others. So I just want to send them a virtual hug as well. And so I was an econ major at Spelman College and left the Gulf Coast, Mobile, Alabama, to come to Spelman. So it was the big city, and learned about taking the train and all the things you don't do in the state of Alabama. And I had some pretty demanding professors. If those of you who were studied econ, I know Adrian did, for sure you remember Dr. Hornsby and Dr. Tribble, Dr. Stone, many leaders who had very high expectations of us as students. And at that time, the president of Spelman was Dr. Janetta Cole, and she put together for the first time a program called the Spelman Emory Partnership. It was also done at Morehouse, and the program was designed to select 3 students who would immediately go to business school full-time for an MBA, and we have a corporate sponsor who would pay for 1 year, and the Goizueta Business School would pay for the 2nd year. Sabrina Warden, who's on the call, she was another one of the 3 that was chosen along with myself and Andrea Horton in 1993. And so we went straight to business school, and you can imagine, just as it is now, most folks who are in a full-time MBA program have worked first, and we hadn't. But the advantage that we had was that we were not as rusty as some of our colleagues. And so we took placement exams, and we waived out of a whole lot of things, including, for me, all econ requirements to get that master's degree. And then we built our credibility over the years working in teams. The next year I was elected president of the Black MBA Association, and that was quite an honor. And several more Spelman students were there. Shannon Jones came, Chandria Covington, several more of us were there, and really being a support system for each other during that time. And so when I graduated, the faculty advisor for Black MBA at the Goizueta Business School is Jeff Rosenzweig, who some of you may know. Jackie Sears, who was there with me during those years, I'm sure she remembers him. He's a very well-known global economist. And he was contacted by a woman who was starting a sabbatical from Bell South, wanting to do portfolio management for high net worth individuals. She wanted a bright student to help her start that firm from the ground up. Dr. Rosenzweig suggested me, and I did that work for about 5 to 6 years. And it was during my time at that firm that I began the CFA program and learned more about what we call institutional investing. So you're not necessarily investing for personal goals like retirement or a wedding or college education for your children, et cetera. You're really investing to meet an obligation at the institutional level, whether you're with a pension plan, an endowment, a foundation, you name it. You're looking to meet a very formal obligation in the future. Relative performance is much more important in the institutional space. You always measured relative to an index, a benchmark that is representative of your own strategy. And I have been with Southern Company since then. So this is my 22nd year. Worked my way through with various levels of responsibility increases, and was promoted to Chief Investment Officer in 2020. And I've learned a lot. I've had asset class responsibilities specifically for the public market side of the portfolio. Our plan was right at 17 billion at the end of 2021. The markets, as you know, this year has been quite challenging. So that market value has suffered some, and we're right around 15.5 billion. However, I'm very pleased and proud to announce to you, as I would announce to my executive team, that our pension plan is overfunded. We are funded at 118%. And when we hit that trigger earlier this year, I took some equity risk off the table and saved us some of the declines that we saw in the equity markets. And so many asked me if I had a crystal ball. The answer is no. But I followed a discipline that many folks who sit in my seat follow, which is if you have created a surplus in assets, you don't need as much risk volatility on the table to meet the future obligation. And so that's something I'm proud of from my team as well, that we adhere to that discipline. So that's how I got here. I am married. I married a friend from high school. We were not dating. We weren't that corny. We became friends and then started dating. It was super weird at first. I have 2 children. My son is a junior, Michael, at Morehouse College. And my baby girl, who I just returned back from DC visiting over the weekend, is a freshman at Howard University. And let me just say, in case you're wondering, I fought the good fight to persuade her to attend Spelman College. I lost that fight. She has a mind of her own. She fell in love with DC. I even leaned on Adrian's shoulders from time to time and asked, where did I go wrong? But this is a generation of young people who can make their own decisions. And while they appreciate our own legacy, they want to have something of their own, and that I can understand. So that's sort of how I got to be sort of here and who I am and the work that I'm doing right now. So I have a couple of slides that I'd like to share with everyone. We're going to talk about bonds as an asset class today, because that's what the team has asked me to cover. So starting with the next page, let's make sure I can page down here. Will it let me?
Are you controlling it or is someone else controlling it for you?
I'm controlling it. Okay, here we go. Okay, so essentially, what are bonds? Bonds are debt instruments issued by an entity seeking capital in the financial markets. The debt issuers can be the US government, so i.e. government bonds, treasuries, etc. It can be corporations, both public and private. And it can be municipal agencies like the state of Georgia or city of Atlanta, or even banks. And an investor who purchases a bond from an issuing entity receives what's called a coupon payment or an interest payment during the holding period of the bond, and hopefully they receive a full return of principal of the full loan amount at the end of the holding period. So debt is really considered to be one of the primary asset classes for especially those approaching retirement age, because it generates a fairly stable income stream to help support your lifestyle and your living expenses. It also is a great diversifier in a well-diversified portfolio. It has return results and appreciation results that have a low correlation to stocks, both domestic and international, private assets such as venture capital, as well as real estate. So any real estate investments that you have typically won't perform in the same way as a bond will. And why is that great? So asset classes that have low correlations to each other means that when one asset class is doing very well, the other may not. And so, so for example, in this market right now where interest rates are going up, usually there is an inverse relationship between interest rates of a bond and the par value of the bond. But you and I can purchase a bond at a very attractive interest rate, much better than what we would have seen a few years ago when interest rates were at an all-time low. So it's a diversifier. And it's also, as I mentioned, a great source of income. So what is the risk associated with bonds? The major risk associated with bonds is default risk, which means the issuer is unable to meet the obligations of those coupon payments or return of principal. The good news is that there are credit rating agencies that are public agencies that assess credit ratings to every bond that you could most bonds that you would be interested in. And so you can see here on this chart, I've listed the Moody's organization and Standard & Poor's. And you'll see that the lowest risk or the highest grade of bonds are certainly AAA bonds down to AA bonds, single A bonds. As a minimum, for certainly a pension plan like the one we have at Southern Company, we require a bond portfolio that is at least investment grade, which means it needs to have a credit rating of BBB or better. Anything below BBB is considered in most cases in the language a junk bonds, air quotes, which means higher risk of defaults and sort of low fundamental metrics for the issuer. So that is one thing to keep in mind. The default risk is key when deciding what types of bonds you want to invest in, and you can always rely on these public credit rating agencies to give you a guide on how healthy the bond is. So moving on to the next page. This is just really an illustration of the risk-reward relationship. So starting with types of bonds that we talked about, you know, the lower the risk, the lower the return. So if you have high risk, you give up the high return. If you have higher risk, then you have to have, then you require a higher return to absorb that risk. So starting with government bonds that are backed by the full faith of the US government, they are considered really the lowest risk bonds with the lowest default rates out there. Treasuries specifically are a great hedge to inflation. So as inflation increases in the way that we've seen in the last 2 years, the value of treasuries moved in tandem with those increases in inflation. Corporate bonds are bonds that are issued by Fortune 100, Fortune 500 and beyond companies, and some private companies that are attempting to restructure themselves and eventually take themselves public. Corporate bonds are subject to those credit rating agencies as well. So we have, certainly at Southern, we have bonds that we've issued over time, and we have the credit agencies who come in and take a look at our earnings growth, our top line revenue, any headwinds that we're facing in the economy, energy prices, all of the things that might impact the fundamental strength of our company, and they will assess a credit rating. Thankfully, ours is still fairly positive. We have a large project underway. We're building new nuclear units. It's gone a little bit over schedule, as you would imagine, with such a huge capital project, that we did see some downgrades in our credit rating agencies, but nothing that moved us into below investment grade. But that's just an example. You know, UPS issues bonds, Home Depot, you name it. Most Starbucks, Target, Ralph Lauren, all of these companies that are publicly traded will issue bonds as well. And that's, again, it's a way for them to access capital to fund the major projects and growth that they have in store. And then finally, another term that sounds a little bit nicer than junk bonds is high yield bonds. And that basically means that investors are satisfied and comfortable with a higher default risk, so to earn a much higher return, in some cases an equity-like return, when they believe that the issuer has an uptrend in store, improvements in their revenues, improvement in their credit ratings, and they believe they have information that is not necessarily public information. They found some undervalued assets and they believe they have better information. And so they view it as a return opportunity. There are some investors who, lose their shirt in this space, and there are some who are right. And so I thought it was worth just sort of taking you through that right there. So on to the next page. Other forms of fixed income that I thought I would highlight that many of you have probably heard. So mortgage-backed securities are also a bond-like vehicle, and they are usually securities that are put together by a bank, usually a mortgage bank, and the underlying assets are real mortgages with payers and borrowers like ourselves. They securitize those several mortgages and issue it to investors. Now, it's important to point out that the structure of a mortgage-backed security is critical. So many of you remember in the global financial crisis in 2008, most of the driver of the decline in the market was the collapse of mortgage bonds and mortgage payers. There was a high focus on interest-only mortgages, where you could buy a home and for 5 years pay only the interest amount, not the principal. And then in the 5th year, you start your principal amount, but in a catch-up way. So we're talking, a large home, maybe a $350,000 home, where families and homeowners were paying close to $800 or $900 for such a nice larger home. And then in the first month of the 5th year, 800 went to 2,700 in one time. And at that point, many people defaulted on their mortgages. There's a lot of blame to go around for what happened in that scenario. It inadvertently, disproportionately affected people of color because we were sold bonds with a pitch that didn't give us all the details. So due diligence, ladies, is always critical. If anyone is trying to pitch any type of investment to you, you always want to ask, what are the downside risks? How can this go wrong? A lot of brokers were selling these bonds as if in 5 short years, people would triple their annual income. And we're all bright enough to know that
it's 7 o'clock.
We can certainly, win the lottery, but barring that, slow and steady wins the race. And most of us do not triple our salaries over a short 5-year period. Another type of fixed income is an asset-backed security. And asset-backed securities are typically bonds or securitized bonds that are backed by credit card balances or receivables of company. They also pay income as the borrower pays their credit card payment requirements. These assets are typically collateralized, so the investor who realizes, what the underlying is, it's not necessarily the full faith of the government or the credit worthiness of a large corporation, but it really is individual consumers who have credit card balances. And so the investor will require some level of collateralization to purchase that kind of security, but it can be a very profitable investment. and another source of stable income. And then finally, there are what we call municipal bonds. So those are bonds that are issued typically by a state, city, or county for infrastructure and construction projects like highways, bridges, schools, airports, most economic development projects, even the Mercedes-Benz Stadium probably issued bonds when it was being first developed and budgeted for. And so that's also another source of a bond-like return distribution. One of the other good things about municipal bonds is that it is tax exempt from federal taxes. So it is very popular among high earners who are in a high tax bracket. And it's also popular for various types of asset pools. There are some that I manage as part of my job that are taxable trusts, unlike the pension plan. We like a good municipal bond allocation to create a tax efficient investment strategy. So those are just some examples that are not necessarily your plain vanilla bonds. So with that, it's just a little bit of an overview of what the risks are, how they're structured, various types of bonds, et cetera, what the return distribution is like, why it's a great diversifier in a broad portfolio. And with that, I am certainly happy to open it up to any questions that you might have for me.
Yes, I love this. Thank you so much, Dakia. If we can see your beautiful face,
Okay,
I want to go ahead and re-spotlight you real quick.
all right.
If you
Stop
could just,
sharing there.
yeah, stop sharing and then I'll
Okay.
spotlight you. I do have a question that I wanted to make sure that I did ask you, and that is, you talked a little bit about, so I come from the fixed income world. I worked after I graduated from Spelman. I went to work on the trading floor in fixed income. And
Mhm.
so I did mortgages, asset backs, commercial mortgages, and so some governments. So that was my world. But you talked a little bit about low correlation asset classes, right?
Right,
So today, you would think that because stocks and bonds are supposed to not have that correlation, right? One is
right.
should perform, when one is performing well, the other one shouldn't. How do you explain how bonds have not performed while also at the same time the stock market has not performed like we would have expected?
Sure. So investment theory says, and it has proven to be true, that in times of market crisis, the correlation of all assets increase together and fall and rise in sort of lockstep with each other. So for example, in 2020, when we found out about COVID in the first quarter of 2020, when there was a huge decline in markets, that correlation benefit really went away and all assets fell because that's a macro sort of risk concern that was covering and hovering the market. So we went from that to markets opening and businesses and economies opening to now having macro risks like rising inflation and energy prices, et cetera, that also tends to create what's considered a more market crisis environment. And you see those correlations that you once enjoyed being low become higher in times of challenge. And so we saw that in 2008. We've seen that in other periods. We saw that in the tech bubble from 2000 to 2002. There was really nowhere to hide when you are having macroeconomic challenges in the markets.
Absolutely. That's good. It's one of the questions I get almost daily. And then the other question, because look, I know there is a whole mix of sisters from different classes, different age groups here.
Sure.
And Jennifer, I thought we were going to talk about stocks, right? And so why are we talking about bonds? So tell me, I call myself a geriatric millennial. I'm not really a millennial, but I'm millennial adjacent, okay? And so my first true love was bonds. Okay, so I do have a big passion for bonds, so I'm glad we're kicking it off with this. But when or why would bonds make sense in a diversified portfolio? I know you can speak to that.
Sure.
And I know that there are some questions around why do I need to pay attention to this, or why would I want to know about bonds?
Okay, so I'm going to try to explain this. This is supposed to be a skill of mine with my executive team to explain complex ideas in a very simple way. So good for you, Jennifer, for testing that skill set that I need to always work on. So, for example, in the kind of work that I do, specifically overseeing a retirement plan, there's the assets, which represents the total portfolio of various different types of asset classes, and then it's the pension liability, which our plan is still open and is accruing benefits every day. And so we can measure the present value of that obligation using discount rates, et cetera, average compensation, years of service, service costs, interest rate and inflation costs, et cetera. So one of the greatest benefits in my space specifically is that bonds are a natural hedge against that long-term retirement obligation, because you can structure bonds in a way that it moves in lockstep with your obligation. So not to get too technical, but if you think about duration, which is the amount that a bond would change if interest rates change by 1%. If you can match the duration of your liability with that of your bond portfolio, then you are essentially hedging any risk of mismatch. However, if the plan is still open and accruing, you need return-seeking assets. So when I talked about that de-risking step that I took earlier this year, when our funded status improved, I moved our return-seeking bucket from around 77% down to 70%, and I increased the bond allocation from 23% to 30% so that I can get a better hedge, sort of bang for your buck from the bond portfolio. So in some ways, the target that you're trying to reach, whether it's a retirement obligation for several participants or even a personal retirement for individual investors, bonds typically give you a better protection of principal, lower volatility, and income that can match the cash flow needs that the investor will have in the future. So that's sort of one big example in my world. The other thing that I did not mention that I should, which I'm sure you know, Jennifer, is the idea of credit spreads. And what that basically means is that, if you invest in what we call the risk-free rate, treasuries, government bonds, lowest yield possible because of the lowest risk, it is from that basis that a credit spread is derived. So if you're deciding to move away from government or treasury bonds and invest in a Starbucks corporate bond, then the investor requires a yield higher than the yield on government bonds to compensate them for the risk they're taking for that investment. So if government bonds are yielding 2.5%, then a Starbucks corporate bond should have a credit spread of at least another 200 basis points and yield around 4 to 5%. And credit spreads are essentially an indication of the risk that you're taking with that certain bond. I should mention that.
It's like the credit of an actual security, right? Like we have credit scores. It's like the credit score, the embedded credit score of that particular company.
That's right.
That you're investing in. Absolutely.
That's right.
Absolutely. Well,
So,
guys,
Jennifer, I'm going to jump in here.
Oh,
I'm going to
yes,
ask
go
a
ahead.
question, right? Just to bring this clarity. You mentioned the different levels. Can you give the range, right, of what the yields would be, whether you're doing a junk bond,
Sure.
versus saying low, medium, high? Can you talk about that? And then also, you didn't mention this, but I think it's noteworthy for everyone that our colleges and universities also have
Sure.
bond ratings. And so as you're thinking about what to invest in, you know, there may not be a company, but there could be a school, an institution that you want to look at. And it's also important for us to pay attention to what our bond rating is for Spelman, Morehouse, and other HBCUs along the way as they seek to get this money in, get the capital, right? In order to invest in various projects around campus. So Dakia, can you just speak a little bit to that?
Of course. So as I mentioned, a government bond will have the lowest yield, somewhere around 2%, and with interest rates up maybe 2 to 3%. These are the yields that you would see in a bank savings account, which is, or a money market fund, or any vehicle composed of government bonds. An investment grade corporate debt will typically yield somewhere around 5 to 6, maybe 7%, depending on the default risk associated with the company. A high yield bond will typically yield somewhere around 10 to 13%, which is even higher than your return expectation for equity markets. So you gotta be right most of the time when you're in the high yield bond, high default risk space. But there isn't really an example of yields that are, you know, much greater than the low teens, because those kind of return expectations we expect to see from, you know, venture capital, real estate, or technology stocks, or you name it. But a high yield bond, high yield for junk bonds is somewhere around 10 to 12 to 13%. And as you mentioned, in terms of endowments, just like a city or municipality, colleges will have huge capital projects themselves, which could be expanding the campus, building more dormitories, building more facilities, you name it, and they can finance that expansion by issuing bonds as well. And so they too are subject to a credit rating assessment by S&P or Moody's. So very well, duly noted, Adrian, good point.
That is awesome. I know that we do have, so one of the questions that popped up, because I do want to keep it moving, because if you guys couldn't tell, we're investing in bonds, okay? So I'm going to give out the assignment towards the end, but yes, we are investing in bonds and we have a lot of latitude within that. But one of the questions that came up, Dakia, and I don't know if you are comfortable answering it, or maybe giving some information on it, but what are your thoughts on I-bonds right now?
Inflation-linked bonds, is that what an I-bond is?
Yeah, so the I-bonds, yes, they're the inflation-linked bonds, and they are what is performing right now in the space. And so if you don't have any details, I do have some information.
Okay, so I might punt to you, but I will say this about the economic environment, which is Spelman Econ 101. So a full recession, ladies, is described by periods of high inflation, low employment or high unemployment, and being a net importer, so we're not exporting goods as well as we could. Interest rates are rising. The Fed is really, when the Fed raises rates, it's to really incentivize consumers to save more and to spend less to bring down inflation. So if you can put dollars away and earn a higher yield, then maybe you won't use that cash to go buy another home or, another, I don't know, big screen TV, you name it. If you incentivize consumers to save more, that can bring down the inflated prices that you see. However, this market is one where unemployment is very low. And some believe, and I agree, because based on Econ 101, Spelman College, that low unemployment, which means that the job market is healthy and there are workers who are still, working and able to take care of their families and deal with higher gas prices and et cetera, that tends to offset the negative impact that you would normally see in a high interest rate, high inflation environment. So it's a semi pseudo recession. So what does that mean? That means that if it's not a true recession and that inflation can within the short term reverse itself, we've already seen gas prices go down over the last 6 to 12 months. Then if you make a bet on an inflation-linked security, when all of the economic indicators are not necessarily pointing in the same direction, you can make the wrong bet, right? And so we have to look at the full economy, GDP growth, everything together, and not necessarily one or two factors to make a decision on, what we expect in terms of market outlook.
Absolutely. What I always default back to is, listen, what are your goals? What do we talk about were your goals? What are you focused on, right? Are you maxing out your 401k or getting close to maxing out your workplace retirement plan? Have you
Right.
fully funded your emergency fund? Do you have your medium term money where, do you have that? If you just happen to have a whole pile of cash sitting off to the side that you just don't have anything else to do with, then I-bonds is something to take a look at.
Sure.
Because yes, they're yielding 9.67% currently. That rate though resets every 6 months. It is very much tied to how the interest rate is moving, but it's only locked in for 6 months. So yes, it's paying more than your savings account. It is paying more than a money market, paying more than CDs. So absolutely, but just know that there's a maximum you can put in. It's $10,000 a year. That's the maximum. And the rate resets every 6 months. And you're expected to keep the money in there for 5 years. But you can take it out at any point, but just know that you would lose the last 3 months of interest that you would have earned if you take it out. So there is a bit of what they call a penalty on it. But yes, it's yielding. But those are just it's got some yield spread there. But make sure that you've got your goals in front of you, and everything Jakia just said about the economy that you've taken a look at, that you're not just saying, hey, I'm taking my 401k money and I'm going to dump it in I-bonds, because you can't do that. Okay. Just make sure that you are investing with your head and not the headlines, right?
That's right.
Not your emotions that's leading it.
And it's always great and better, as I would say to my executive committee, we are long-term investors. And that type of vehicle, to me, sounds like a tactical strategy as opposed to a long-term strategic plan. And so tactical basically means that you reshift and rebalance your portfolio based on short-term indicators. Those traders and noise traders are out there. But they typically do not outperform strategic long-term targets, because the timing of when to get in and out of an asset class like an I-bond is typically you're actually getting in after prices have already been high, so you're actually paying too much and you're getting out too late. There's a lag that investors like you and me will have by the time that most folks in those I-bonds or high savvy investors have left I-bonds, and then now you're selling too low. So we actually avoid market timing. It's a hard strategy to implement and to maintain. But if you have, to Jennifer's point, assets that you feel are free and fairly disposable, it's something to think about, something to, to consider.
That's right, because we don't have a crystal ball and we're not timing the market.
If I did, we would all be rich, ladies.
Amen.
I would share it.
Amen. But I do have one question though, Dakia, because I know with some who are, we're econ majors and economists and everything, we learned very early on that the market was efficient.
Yes.
But in today's day and age, when we're talking about pseudo recession, that wasn't the typical. And so for this group, as we're really thinking through minimizing risk,
Mhm.
right? And not taking the, having the whiplash of where the equity market is today.
Right.
What just basic things, because you mentioned discipline in your opening,
Sure.
conversation, and what would you advise, right?
Sure.
For women to kind of quiet the noise
That's right.
around them?
I'm glad you brought that up, Adrian, because that's a topic that's close to my heart, and I'll tell you why. And I think it's something for women of our caliber to know. So markets are generally, we are taught in Econ 101 that markets are generally efficient. What does that mean? That companies like Southern Company and Starbucks and UPS, all of the available data about their earnings projections, their growth rates, the analyst ratings is public information. The most inefficient markets is where that type of data is limited. It's usually in international markets, specifically emerging markets, or small cap markets. So smaller companies that are not as large as Fortune 500, Fortune 100 companies. So the best opportunity for alpha is performance over a benchmark, is in the inefficient asset classes. The large cap domestic stock space is in fact the most efficient market to be in and the hardest to outperform. And in fact, most investors will index that part of their portfolio. So to the extent they want exposure to large cap domestic stocks, they'll buy the S&P 500 and leave it at that. But the reason why this subject is dear to my heart, and I want you all to know, is that there has been a decline, unfortunately, of Black-owned asset management firms since the last few crises that we've had. Many of those firms' flagship products were large cap domestic stock strategies. As the markets become more efficient and investors like a pension plan or an endowment is trying to reach a certain return target, it's going to look for sources of true alpha as opposed to index-like returns. And many of these firms who only focus on that space and had a product in that space, it was hard for them to compete for talent because the opportunity to outperform, you can't charge an asset management fee when you didn't really outperform the benchmark. If you earned 8%, the S&P earned 9% or 8.5%, no one wants to pay a fee for, and then which means you really earn 7.5% relative to what you could have earned in an index. There have been several firms like Herndon Capital here in Atlanta, Georgia, Holland Capital in Chicago, several other firms who have closed their doors because they needed to have a developed product where alpha is more possible and likely to attain. So part of my job and part of what I do is to source Black-owned, women-owned asset management firms who have a demonstrated track record of creating alpha. Those who I have been able to successfully recommend to my committee of CFOs are killing it, hitting the ball out of the park, but they are investing in the emerging market space, or they are investing in small cap companies that don't have a lot of analyst coverage. They find diamonds in the rough, early, and they have disciplined sell, targets, and they are able to, and they've made me look good, frankly, for, I think my first hire for a Black-owned firm was Ariel Investments in Chicago in 2008. They've made me look brilliant ever since. So be cognizant when you're choosing a mutual fund where the advisor is a Black-owned firm, that they are offering you a strategy where you actually can outdo better than if you were in a passive index product. So that's as you can see, that I'm very passionate about advising minority-owned firms to give the market what it's asking for. Make your strategic business decisions on what investors will need in the future. So great point, A.
I love that. And I need to spend some time with you because I want to get some Black asset managers on our platform. So that's a big thing that we're working on right now. And then for our November meeting, we do have a Black asset manager that's coming on that's talking about small and mid cap stocks. So,
Okay. And why don't I just give you a plug for a Black-owned, woman-owned bond manager?
okay.
Pew Capital Management, PUGH. She is a rock star. I haven't got her over and persuaded her yet because I want to put her in some foundation portfolios before I put her in the pension plan, because there our bond strategies are specifically to mimic the liability of the retirement obligation. But in my foundations and other trusts, or my bogey is just, the Barclays Ag Index. I have invited Pew Capital, but she takes nothing less than $10 million. And so I have to give her, she's out of Seattle. She has a tremendous track record. She's on my radar. She doesn't want small money. She wants big money so that she
Sure.
has the breadth to pick a well-diversified portfolio. But I'm so proud of her. I'm a fan of hers from afar. And I'm going to find a way to hire her soon.
I love it. I love it.
So if she has a mutual fund, ladies, please look for Pew Capital Management.
Awesome. Well, with that, I'm going to just say thank you so much, Takia, for kicking us off for this year's investment club. We really, really appreciate it. And thank you for dropping all these jewels, because I know when you guys get the assignment, you guys are just going to love it. Okay. Love it. Love it. Love it.
Now, before we let Takia
Yeah.
go, there is a question.
Okay.
Do you have any books, podcasts, or other resources that you would recommend for those that are just starting out on their journey for investment?
Yes, that's a good question.
Thank you, Lauren.
So the founder of another Black-owned asset manager I hired called Brown Capital in Baltimore, Maryland, was founded by a huge philanthropist by the name of Eddie Brown in that area. He wrote a book. The name of the book escapes me. I can see it because he signed it for me. But please research Eddie Brown, and he tells the story of how he learned everything he knew at T. Rowe Price, went on to start Brown Capital, and has been tremendously successful. But he also talks about learning lessons in the financial markets. That's great. I read periodicals that require a subscription. So I read what's called P&I, Pension and Investments Magazine. They're always offering seminars and podcasts, etc. I think CNBC is a good place to start, just to make it a part of your day, to sort of watch and see how the markets are behaving both domestically and internationally. You'll also get a lot of economic news on if the Fed's raising rates, what else are we seeing with GDP and unemployment, et cetera. If you can find a way, and certainly the Wall Street Journal, and then we as investors, you'd be surprised how many of us can use our own observations to know whether Home Depot is better positioned than Lowe's. I have asset managers who come in and say, I don't want to own Marshalls, I want to own Ross, right? And I've said, why? Because Ross doesn't have anything in there when I go. And but an asset manager says exactly, their inventory levels are low. That makes their costs low and their revenues and margins higher. And it's true, if you go in Marshalls, there's stuff everywhere. But from a business investor hat, is that really accretive to the bottom line? So you'll be surprised how, I think Dunkin' Donuts might take more market share from Starbucks in the next 5 years. But hey, that's just me.
Ooh.
I don't think Starbucks will be able to bully everybody's wallet for much longer, but that's just me. There's a time where it's just a trend, and is it really much better? That's what the question will be, especially in an inflationary environment. So you'd be surprised how you can find great investment ideas. During the pandemic, Zoom was a huge stock to be in. Spotify and these companies that offer grocery apps delivery, like Instacart, et cetera. Every economic environment has a good or service that can accommodate that environment very well. So if it makes sense to you that that's probably a promising stock, literally Google it on CNBC, read the fundamentals, look at their margin, their revenue growth, their earnings growth, and then sort of get Google analyst ratings. If you see a whole lot of buys or, holds and buys, a lot of positive ratings, that's a good indicator. But use yourself as a resource. You'd be surprised what we all know here just by what we observe.
Absolutely.
Well, Dakia, thank you so very much. This has
You're
been outstanding. The information spot on.
You're
And so
welcome,
I
lady.
know that we'll be able to put this to work.
All right, call me back
Absolutely.
anytime.
And
We
listen, I
will.
would be remiss before we let you go to not acknowledge the Spelman cardigan with the matching glasses. Okay?
Yeah, that's
It's
right.
Glasses
beautiful.
are the bomb. Yes,
Yeah, you did all of that.
yes. Love
All
those
for
glasses.
y'all. You gotta show love.
I love it.
Coordinated.
I
All
love it.
right. Much success and health and happiness to every one of you. Take care.
Thank you.
All right.
Thank
Bye-bye.
you.
All right, ladies, we are turning it over. We want to kick it off. We still have some business to cover really quick, but as we keep it moving, I just wanted to really quickly to see where our portfolios stand right now in lieu of everything that Dakia just talked about. What do we look like right now? Okay, so just really quickly, our stock portfolio, I've highlighted the stocks that are leading the way right now. And so you can see number 3 is T-Mobile USA, right? Apple is number 2, and number 1 continues to be ExxonMobil, right? With gas and oil stocks continuing to have a tear, right? And so what I will say about gas and oil, I was talking to my energy analyst earlier today, and she said, hey, listen, we still see a lot of positives in energy, even though gas prices have come down. We still see that there's room. It used to be about 2 years ago that these energy companies, you know, when they needed to find more oil, they were going to go and drill more holes, right? And so they used to just use all the money they had, and really they didn't have a real system for using the, you know, the company's money. And so what they've done today is they've gotten smarter about their capital expenditures. And so maybe that's because of where we are in the economy right now, COVID, just becoming way more efficient. But they have decided that, hey, look, we're not just going to keep drilling more wells. Let's take a look at how to make our existing wells more efficient, right? And so she said, hey, I still see gas and oil and the energy sector still doing well, at least through the end of this year. So I know there's a few of y'all that did invest, not just in Exxon, but there was some other oil investments or energy investments. So congratulations on that, okay? We are, as of today, because I know, look, we're negative in our stock portfolio, but we are beating the S&P 500, okay? I don't know where we shook out with the new the interest rate hike that happened today, so how the markets reacted. I came from somewhere else, so didn't get a chance to check, but when I ran the numbers earlier, the S&P 500 was down about 18%, so we are outperforming by about 5.5%. The S&P 500. Okay, so that's awesome. Okay, now our mutual fund portfolio hasn't done as great. And so our mutual fund portfolio, just so you all know, is down about 18%, but that is very much in line with where mutual funds pretty much are. Again, mutual funds that have a higher concentration in energy, in utilities, and in consumer staples have actually fared a lot better than mutual funds that are just definitely growth stocks, right? Even value stocks, and those haven't fared as well. Financials have not, and definitely if anybody's been following technology, they haven't done great, but great in my world means they are on sale. So where Facebook was during 2020, where Netflix was during 2020, where Zoom, where Google, where all of those tech stocks were in 2020 when they were at their high, they are actually a buy right now, because we are supposed to buy low and sell high. And this is an opportunity to actually buy low, okay? Our mortgage-backed securities, for those of you that were with us last year, we did invest in mortgages, okay? So we covered mortgage bonds, mortgage-backed securities. And so that portfolio is also down. It's down about 13.5%. And then quickly, just because we have to move, our crypto portfolio is down the most, which should not be a surprise to anybody, right? But we are down 51% in our crypto portfolio. And you know what, guys, what I say, ladies, about this, we aren't choosing failures. These are all learning opportunities for us, okay? So we're getting to touch and learn about different asset classes, okay? Let me stop sharing this. Adrian, I don't know if you wanted to comment on any of that as I pull up my next thing.
No, the only thing that I would say is that this is a test. So thank God none of us have $1 million or 10 million. What was the minimum? She said 10 million to
10
put
million.
in.
Yeah.
Based on the performance. So as you're learning with the $25 a month minimum investment, it's a good way for you to see what works and what doesn't.
Absolutely. All right, so I'm going to move on to club business. We talked about what our mission is. Our club is committed to educating alumni about all investment classes, all asset classes. So the minimum, these are processes and procedures for the club. So to join the club, we are asking for a minimum of $25 a week, $100 a month is your commitment into your own investment account, okay? That is what we decided. The investments need to be made 1 week before the next month's meeting, which is in November. But if you notice, there is a monthly commitment of $100, but we meet every 2 months, which means by that second month, you really should have committed $200 to whatever that asset class is that we are investing in, okay? For your investment to be considered for purchase by your group, because you're going to be grouped, each group needs to do an evaluation on that investment. And it's got to be agreed upon by all members, right? Before that investment can be purchased, because that investment will be purchased by all your group members into your own individual accounts, okay? I talked about myself, just if you want to read about my background, I'm not going to cover that because we talked for a while, but I want to get to the club business, our goals. I think we talked about that, so I'm going to move through that really quickly for time's sake. But in terms of trading platform, sisters, we are agnostic to any platform you want to use. Choose whatever platform you've heard about, you've had seen an ad for, as so long as you can purchase stocks, bonds, mutual funds, ETFs, REITs, or some kind of real estate product. You just want something where you can purchase everything. Crypto is not going to fall on that, but you want a platform that will handle the most asset classes, okay? So that's what your filter should be. So if you have an existing relationship with Schwab, TD Ameritrade, go for it. We can work on whatever platform so long as they can handle all of those investments, okay?
Jennifer, 1 second. There's a question from Jennifer Felder.
Go ahead.
Jessica Felder.
Does this include M1 as a trading platform?
Is that the name of the trading platform?
Yes, it is a newer digital platform where you can buy REITs, ETFs, everything, but you can buy portions of stocks.
Yes. So yeah, I'm glad you said that. So yes, we don't care what platform you use. We leave that up to you so long as you can buy all of those things. And yes, as fractional shares. Yes, absolutely. So it's so long as it allows you to buy fractional shares of stocks or bonds. Mutual funds are already fractional shares. So long as it allows you to buy pieces of all of those things, go for it. Absolutely.
Thank you.
All right. So after we leave here and you have heard everything about tonight and you get the assignment, you are going to hear from me, and I will send you an email saying, number one, you'll probably get a survey saying, would you like to join the club? If you are not already a member of the Atlanta chapter or any other chapter across the country or anywhere, then you need to join, right? If you are already a dues paying member, then we just need to have receipts for that, right? And then you can join the investment club. After that, you just need to let us know that, yes, I'm willing to join. We are going to create the teams, okay? Our sisters that are already part of teams, that have been part of teams now for the last 2 years, we're reshuffling teams, okay? I want to say that I heard your surveys, okay? I heard about how you felt like some groups had way more knowledge and some groups had very little knowledge on investing. So we are going to shake up the teams to make them way more equitable so we feel equally supported in each group, okay? Also, you will get your homework assignment, okay? In that homework assignment, Adrian and I also saw your responses about the presentations, okay? And so while we cannot necessarily look, part of presenting, we're going to know the day of who's going because we want to make sure everybody's prepared and everybody's done the homework. I think we can, and I'll talk about that in a second, we can scale back on the amount of work because I understand we all have other jobs. We're all, mothers, wives, sisters, daughters. We have a ton of stuff going on. And so there are ways to scale back the amount of work, okay? So yes, we heard that, okay? Here is a sample presentation. I am showing you this just as a sample, but I want you, when you get the information about the assignment, I want you to, as a team, evaluate what are those things that you think are the most important in your evaluation for your investment in a bond, okay? And so it may not be everything that you see that this team chose here to take a look at, right? And so I think to make things a little bit easier, what I would say is, look, amongst your team, just choose 2 options and that is it. Some teams start with a big list and they narrow it down and narrow it down and have this huge funnel. And I appreciate that because I love that for me, because I'm a nerd. But I want you to know that you don't have to do that. You can say, hey, I want to choose this bond, and that's what we're doing our evaluation on. And then we're going to do the work to see which is the better of that and of those two to invest in. So you don't have to have a huge pipeline. So I do want you to cut back on your work and then choose those characteristics of that investment, that asset class, specifically bonds, that maybe you care about or you think that are very, very important. And then your presentation should focus on why you thought those had merits, right? In your presentation for you to make that investment, okay? So here in the presentation, they shortlisted what they wanted to invest in. They compared 3 different index funds here, okay? You see that they talked about, what the objective, okay, these were mutual funds, what the objective of each of those mutual funds were. Listen, you guys can actually collapse some of this and actually do it just for the one that you ended up investing in,
Right.
okay? Instead of showing all 3 or however many you decide to focus on, to cut back on some of that. You can talk, they're showing the holdings in this particular mutual fund. You want to have a slide that does talk about what the returns have been, okay? So you want to have that for all your investments. That's not one you're going to be able to get away from. And so this is just a sample. I will drop a few other samples of presentations for you so that you can get a look at someone who did a very in-depth presentation and another team that did not, that did maybe a more scale back version. And you do in your group what you guys are able to do with whatever capacity you have, okay? I don't care, and Adrian, we didn't talk about this, but I don't care about roles. What I want you all to do as a team is decide how you're going to split up the research, right? Who's going to work on what portions of the presentations. Y'all can do that yourselves and decide who's going to present. Some teams choose to have multiple presenters, and some teams choose to have one person present when it's their time to go. You decide that. We're not choosing this time, okay? But what I am choosing is I am choosing the person who is going to update the investment tracker, okay? This is super duper important. We want someone that can, when it's a week before our next meeting, we want to have the investment trackers updated because we want to be able to present to you how our portfolios are performing. That's really, really important. And we can't do that if we don't have the data. And I can't do that. And Adrian can't do that because we both have full-time jobs if we do it last minute. And so we do a disservice to you guys because we can't actively present to you how we're doing because we don't have the data. So we just ask that you give, you input everything, whoever the assigned investment tracker is, does that a week before the next meeting. So we have enough time to tabulate the results, which also means you have to have all your investments done a week before the meeting, okay? And I know I'm talking really fast because I want to be mindful of the time. Ladies, go ahead and screenshot this, okay? Because one of the questions I get all the time via email and text is when is the next meeting, okay? I want you to screenshot this and I want you to add it to your calendars now so that you don't say, hey, Jen, when's the next meeting? I love hearing from you, but listen, here are the next meeting. Screenshot them and put them in your calendar, okay? So the meetings on the left-hand side are the actual meetings where we will be presenting and we will be hearing about the next asset class from a speaker or, a subject matter experts. On the right-hand side are those special meetings. What is that? That means that we may have a guest speaker who doesn't have a topic that's necessarily an investment for us, but is something that's of interest that goes along with financial planning or investing that we think is valuable. It is also a time for some of you all, because I want to make sure we do still do this, is extra help. That there are times when, man, Jennifer, I just didn't get this last, asset class. I don't understand how to make this investment. We just need a little bit more guidance. And so those meetings are designed to provide some additional help and additional clarity to maybe get through some stuck points that some of us may have. Okay. I see some questions.
They're mainly comments of how
I
they
got
need
it, I
extra
got it.
help.
Listen, and then what I also say about this is, we record every single meeting. And so we do that because sometimes you're not able to join a meeting, but you going back and they're recorded and uploaded to YouTube. And then what I do is I follow up and I send everybody an email and I say, I cover what the assignment is. I say, hey, I've already dropped this stuff in your Google Drive folders for you. And here is the recording in this email. I will embed the link for you. And so listen, you can't come to me and say, I don't know what we covered, okay? Because we record it, it's uploaded to YouTube, and Jennifer emails it to every one of you. So before you say, hey, I need some extra help on the side, I need you to make sure you've gone and watched the
Right.
video where we've explained some of those things that maybe will help you get through some of that, okay? Any questions about anything that we have covered that you don't necessarily have to put in the chat? If you want to go ahead and either raise your hand or unmute and ask for some additional clarity, I am happy to answer. Adrian is also happy to answer, but just expect that you will get a follow-up survey that asks you whether you are interested in joining. All right, Dawn, I see you. Go ahead.
Okay, I don't know how to do the hand thing.
You did a double hand.
Anyway, I'm just trying to get a sense. So it sounds like the work does not begin before November. Is that right? Nothing happens besides you saying yay or nay before November.
No, that is a great question. I'm glad you asked that. You will have some homework. Your homework is probably, you won't get it for about a week, okay? We need to figure out who is in because we've got some new people, we've got some returning members. So we need to figure out first who's in, and then we've got to assign the groups, okay? And once that is done, then your homework assignment will start where you will begin your research for investing in a bond, okay? And I will have that spelled out in an email to all of you. And so you will have any materials. So the slides that Dakia covered, you will have access to them in your Google Drive folder. I will drop in a primer to bonds for you. I try to give a little cheat sheet also that helps for some background. And then that at that point, you as your team and your team will have to get together, decide when you're going to have meetings, how often those are, going to be. I need your team name. And then you guys can get to work, because some teams will decide that they want to go ahead and do their monthly investment every month, even though we meet every 2 months officially. And then some teams will decide that they're only going to invest once a month, the week before the meeting. But in any case, you still have to do the work before that next meeting, because at that next meeting, we kick off with you all presenting what you invested in. So you definitely have to have done the work and have to have made your investments by then. But that was a great question. Any other questions? No?
No other questions?
All right. Well, listen, that is it. We so appreciate you all hanging in with us for 2 hours on a Wednesday evening, kicking off September in the investment club. And we are so excited for you all
It
being
was
here.
an hour and a half, Jennifer.
Okay, you're right. It is an hour and a half.
Yeah, you
Oh
were
my
you were
God.
racing through, but it was an hour and a half.
You're right. You're absolutely right. Oh gosh. Listen, this is awesome. And you all feel free. I'm an open book. So, if you do want to reach out to me, you can email me and you can, text me, and I'm happy to answer. And it's the last day of summer.
Yes.
All right, ladies. All right, sisters. We so appreciate you. Have a good
Thank you,
weekend.
ladies.
Thank you.
Peace and blessings.
Peace and blessings.
Thank you.
Good job, Jen.
Dakia was awesome.
Yeah, she's amazing.
She was
So
a great choice.
Dakia was actually, she was my advisor. First, I didn't
Really?
mention that. Yeah, she was my advisor before she became big time. But before she got her CFA and all that stuff, as she was going through it, I was one of her clients. Camille, do you have your hand up?
Camille does, yeah.
Yes, I wanted to ask, sorry, I'm driving and I had another meeting in my right ear, so this has been challenging, but great presentation. I love Dakia. She did an amazing job for me at a presentation at another organization, so she is always full of knowledge. But when will the survey come out? I heard about the survey, but I missed the timing. And to confirm, the meetings are at 6:30, correct? Not 7?
Correct. Meetings at 6:30, and you guys should have the survey by Friday. I don't know. I've got to get with my communications team and see when we can have it out, but really, maybe by the weekend.
Okay. And if we wanted to invite someone who's in another chapter, not
Yeah.
in Georgia.
As long as
They
they
need to-
paid their dues, it's open to everyone. Whoever.
Okay. And do they need to, you said they need to provide proof that they paid their dues?
Yes.
Yes.
Okay. I'll make sure she knows that. Thank
Yeah,
you.
Definitely invite others, Camille. And if it's someone where, you all would like to be on the same team, you can quietly make those recommendations to Jennifer, but she's still going to make an assessment based on skill level so that we're not too heavy with, really experienced people all on one team.
Got it. Okay. Thank you.
All right. Welcome back, Camille.
Thank you. And thanks for pushing, joining the becoming a member. I always love those membership pushes, everything that we do.
Good deal.
Bye.
Bye-bye.
Good night.
Julie,
Dakia and I both have a junior at Morehouse, so.
yeah, but I called him Bud. His name is Michael.
Okay. Oh, are you guys same class?
No, I pledged to Kia. She's younger. She's like
Gotcha.
93, 94.
Gotcha. I saw she was in New York too.
Huh?
Over the weekend.
What?
Dakia, she was in New York for the game. Over
I
the
didn't see
weekend.
Dakia at the game.
No?
Mm-mm.
I thought she posted something on her LinkedIn that I saw, so.
No, I didn't see her at the game.
I mean, I know she was at Howard with her baby, but I thought I saw.
Yeah, she was at Howard. She didn't. She
No,
was
she was. She was at the
She was
game.
at the game?
I saw her.
At the game?
She posted pictures.
Okay. I didn't
Oh.
see her there. I saw a lot of her line sisters there, though.
Okay. Yeah, I told Leonard we can't miss it ever again.
Well, you have 2 years to plan for New York.
Yeah,
Because
yeah.
I'm telling you, it was way more expensive than what I would have liked. For
Yeah.
just staying domestically and not being on a beach